Hello and welcome back to AI Financial Advisor. I'm your host, Raul Sofa, and today we're diving into a topic that's absolutely fundamental to your financial health, your credit score. Ever wondered what that three-digit number really means? Or more importantly, how to make it work for you? Stick around because in the next few minutes, we're breaking it all down. So what exactly is a credit score? Think of it as your financial report card. Lenders, like banks and credit card companies, use it to gauge how risky it might be to lend you money. It's a numerical representation, typically ranging from 300 to 900 in Canada, that summarizes your credit history. Factors like your payment history, how much debt you carry, the length of your credit history, the types of credit you use, and how often you apply for new credit all play a part in calculating this score. A higher score generally means you're seen as a lower risk borrower. Now, why should you even care about having a good credit score? Well, it impacts more than you might think. A strong credit score can unlock better interest rates on mortgages, car loans, and lines of credit. That means paying less in interest over the life of the loan, potentially saving you thousands. It can also make it easier to get approved for rental housing, and some employers even check credit history as part of their hiring process. In short, a good credit score opens doors and saves you money. It's a key pillar of financial freedom. All right, let's talk numbers. What's considered good? While the exact ranges can vary slightly between lending institutions and scoring models, generally, in Canada, 760 and above, this is typically considered excellent. You'll likely qualify for the best interest rates and terms. 700 to 759, this is generally viewed as good. You should still have access to competitive rates. 650 to 699, this is often considered fair. You'll likely qualify for credit, but perhaps not at the most favorable rates. Below 650, this range may make it more difficult to obtain new credit, and if you do, it might come with higher interest rates. The key takeaway? The higher, the better. Okay, this is the crucial part. How do you build good credit if you're just starting out, or improve a score that's not where you want it to be? Here are some actionable tips. 1. Pay your bills on time every time. This is the single most important factor. Late payments can significantly damage your score. Set up automatic payments if it helps. 2. Keep your credit utilization low. This means don't max out your credit cards. Aim to use less than 30% of your available credit on each card. For example, if you have a $1,000 limit, try to keep your balance below $300. 3. Build a long credit history. The longer you responsibly manage credit, the better. If you have old credit accounts in good standing, think twice before closing them. 4. Limit. New credit applications. Applying for a lot of credit in a short period can temporarily lower your score. Only apply for credit you genuinely need. 5. Have a mix of credit. Lenders like to see that you can manage different types of credit responsibly, like a credit card and an installment loan, e.g., a car loan. But don't open new accounts just for the sake of it. 6. Regularly check your credit report. You're entitled to a free copy of your credit report annually from both Equifax and TransUnion. Review it for any errors and dispute them if necessary. This won't hurt your score. Building or improving credit takes time and discipline, but it's absolutely achievable. So there you have it, a crash course on understanding and improving your credit score. It's a powerful tool in your financial toolkit. Start implementing these tips today, and you'll be well on your way to a healthier financial future. If you found this video helpful, please give it a thumbs up, subscribe to AI Financial Advisor, and hit that notification bell so you don't miss our next episode. Have questions? Drop them in the comments below. Thanks for watching, and we'll see you next time.